Are there systemic risks that are threatening to topple the Chinese financial system and take U.S. stocks with them? Are there new signs that are indicating that inflation is near peaking and about to roll over? And did the Fed indicate that we're any closer to them tapering the balance sheet? Or is it more QE forever? Answer those questions and more on today's Macro Show. I'm your host, Steven Van Metre, and thanks for joining me. There are some systemic risks going on in China that could lead to some serious repercussions. We've talked about this last year, that China may be forced to devalue their currency. We said that it wasn't an if event, it was only a matter of when. And we're starting to see some signs the system is cracking, especially as their stock market heads lower, perhaps being a sign that insiders know what China is about to do and they want out. Let's take a look at the story. It starts with this spiraling debt crisis that's confronting Evergrande billionaire and Chairman Xi. And what's going on here is they've got some serious issues inside their financial system, starting with the very largest property developer, China Evergrande Group, which has raised fresh concerns about credit defaults in the country's highly leveraged, usually that's a good place for defaults to start, real estate sector, and is threatening to spread to other companies. Now, the developer has not defaulted on interest payments yet, but worries persist over its financial health as Beijing steps up curbs on the sector can try to contain the bubble. And that is the problem, because what is the issue is the imminent pressure point is the $32 billion of commercial bills held by Evergrande's main offshore subsidiary. As of December, a series of missed payments this year have marked 24/7 Chinese default watch. So a default is bad news, particularly when you have $32 billion to deal with. Now, this poses two dilemmas for Chairman Xi. One is drowning out the economic recovery narrative. I mean, you can't really have a recovery narrative when you have the $32 billion of commercial bills default by your largest property developer, as he hopes to harness and win a third and unprecedented 5-year term as leader. The other, it tests his commitment to deleverage the economy to squeeze froth out of key asset markets like property. Now, why does a debt default cause problems? Well, because it creates a domino effect and it impacts the banks. And when the banks are threatened with defaults, what do they tend to do? Stop lending and start shoring up their balance sheet. So one of the solutions, and I believe it's sitting on the table, is for China to devalue their currency, because that solves a lot of problems and it's very easy for them to do. Let me show you. Now, this is an older article, but it still actually is really relevant today. And its first question here is, how does China devalue its currency? Well, the yuan is not freely traded and the government limits its movement against the US dollar. So think of it this way. It's tied to a peg. All they have to do is pull the peg out, move it, and put it back in, and it's just that easy. It's not a free float currency. So that is big. Now, unlike other central banks, the PBOC is not independent and faces claims of interference when big moves occur in its value. So effectively, they get labeled as a currency manipulator, but that's not really the issue, because anyone can call them whatever they want. But if its choice comes to watching their financial system implode or devaluing their currency against the dollar, well, you can guess which one they're going to choose. And what this allows the PBOC to do is effectively weaponize the exchange rate, even if it's not proactively weakening the currency with direct intervention. Now, what is the impact of a weaker yuan? Well, it has serious repercussions. We're already seeing some signs of those in the Chinese stock market, and we're seeing it in the U.S. Treasury bond market. A weaker yuan makes Chinese exports more attractive or cheaper to buy with foreign currencies. And from a U.S. perspective, it is seen as an attempt to offset the impact of higher tariffs on Chinese imports coming into America, which, notably, if you did not know, President Biden kept all those tariffs on China that were implemented by former President Trump's administration. So it does allow people to purchase Chinese goods and services more cheaply, but it carries other risks. In fact, if we zip down here, it says, when have they done this before? Well, they did it in 2015. Let's go look and see what damages it does to the equity markets. Well, let's start with The iShares China Large Cap ETF, we're going to go back to the weekly chart here. Here you see 2014 and into 2015. Yeah, it sends Chinese stocks lower. Kind of looks, what we're seeing now. All of a sudden, a big move lower in Chinese stocks. And what was some of the issues that we're hearing right now that's causing this? Well, we're hearing is regulatory issues, that China's starting to regulate more of its tech companies. Well, okay, is that a reason you see a massive sell-off? Well, it could be. There's threats that perhaps this is just the beginning. There will be more. Perhaps that even the United States will see this as an opportunity to regulate its tech companies. And there's some belief that insiders know a devaluation is coming and they're trying to get their money out. And even institutional money managers and other large money managers are dumping their Chinese stocks to get out ahead of this. So we're seeing U.S. funds selling, perhaps creating what could be a feedback loop that lower stock prices even just force China's hand. But let's continue on and see what kind of damage this does to the U.S. equity market, because if we're only here and they haven't devalued, well, you saw what happened in 2015. It went very, very low. And now that China is part of the emerging markets index, well, that could threaten to drive this down. And this shaded line is Steve's line of doom, that if you cross this, usually bad things start to happen. But let's take a look at the S&P 500. We'll jump to SPY, and here you can see 2015 right in here. The U.S. equity market didn't like that. How about treasuries? Well, let's take a look at treasury yields. Where's 2015? We can zoom in on it, and you can see right here, 2015 yields went lower. In fact, what's very interesting to me is if we overlay FXI here on 30-year yields, what we find is they're fairly well connected. And so let's take a look and see how much is driving what's going on here in the market that's coming from China. And let's zoom out here to, say, the 5-year chart. And now let's go out a little bit further to the 20. And so here you can see that yields are rising, Chinese stocks are rising, Chinese stocks start to fall, yields peak, they start to head down. You can see they're broadly heading down together, even though they're not following exactly the same path. Chinese stocks head lower, so do treasury yields, and then they're rising together, and now look, they're falling together. This is just an indication of how interlinked the global economy is, that China can have a strong influence on U.S. equities and U.S. treasuries. But you're saying we haven't looked at U.S. treasuries. Well, we looked at 2015, but how about more recently? Well, let's take a look at that. Let's overlay with SPY. And now you can see when Chinese stocks rise, that is bullish for U.S. equities. When Chinese stocks start to fall, it doesn't mean the U.S. equities completely give up, but it usually means there's with a lag, they're falling. Chinese stocks rising, U.S. equities falling, Chinese stocks falling, U.S. equities falling. You see them on nice path here together, and you see them rising together. And now look, Chinese stocks are leading lower, suggesting that at some point, that if things continue to get worse for China, that not only are treasury yields going to head lower, which are going to tighten financial conditions, but U.S. equity prices are going to collapse alongside it. And that is the danger that we're seeing right now with what's going on in China. So keep an eye on this, because it is a very real situation. And my guess is, if push came to shove, that China will choose to deval rather than let Evergrande default. All right, let's continue on with the data, because we've got some other interesting economic data to take a look at. Let's head back to Tuesday, and let's get into this inflation story, because so many people now are talking about how we are in a secular rise of inflation. This is just the beginning. And one thing we want to look at is durable goods news orders. Let's take a look at these. We'll go look at some charts to see what you think. And we'll start with durable goods new orders in June, missing expectations of a 2.1% month over month, came in at 0.8. Excluding food and energy, only up 0.3 with the core. And now let's take a look and head over to the Fed database. And we've got manufacturers' new orders, durable goods on a year-over-year basis. And you can see they have peaked and are now heading a little bit lower. Now you say, well, what does that have to do with inflation? Well, for fun, I overlaid the consumer price index on a year-over-year rate of change. And what you can see is they were kind of inversely correlated right in here. And they kind of started syncing up in the late 90s. And now you're seeing the CPI heads lower. But look at this, the durable goods new orders headed lower. I'm sorry, I forgot to turn off tooltips. But what happened is these higher prices from durable goods going into the dot-com bubble were rejected. So you had higher consumer prices, durable goods went down, showing you that consumers couldn't afford those higher prices. That's important to understand. And then they get synced back up again coming out of that recession. And now all of a sudden we go into the great financial crisis. The CPI is screaming off the charts. Like now everyone's talking about secular inflation. And look what happens to durable goods new orders. They head lower, and all of a sudden those higher prices get rejected because consumers can't afford them. They didn't have the wage increases, they didn't have the money, and ultimately that led to disinflation and then outright deflation down here. Then they get synced up coming out of the recession, and now they're following each other pretty well, and stimulus drives everything up. But now look, the year-over-year rate of change, durable goods new orders heading lower, CPI heading higher. Doesn't mean the CPI still can't go higher, but we're already getting some indication from this year-over-year data that consumers will be rejecting these higher prices. Plus, we've been hearing from Dr. Lacey Hunt that's suggesting that wholesalers and retailers have been demanding additional orders because they weren't sure when the supply chains from Asia and other parts of the world were going to open up and get goods into the country. So they've been putting in extra orders, suggesting that as the supply chains open up, that they might cancel those orders, which could have a serious impact and drive the durable goods new orders lower, and thus adding further validation that consumer prices are too high and they will end up being rejected, just as we saw in the last two recessions. So I thought that was really interesting. Let's continue on and see what we've got next. Home prices continuing to surge in May, month over month. Remember, this is lagged, so we don't have, we've talked about how home prices are potentially peaking. Now this is May's data, up 1.7% for the month, up 18% year over year. Huge surge. Consumer confidence up slightly. This is the Conference Board July data. Got some slides on that. And oftentimes consumer confidence follows the stock market. And so you see that consumers are still overall confident, even though a lot of these extended unemployment benefits are ending in September 6th. And we know the rent moratorium is going away. And we also know the student loan moratorium is also going away. Or I should say the eviction moratorium would be the more proper way to say it. But how about this the Conference Board's consumer confidence inflation rate expectations? You want to know something that you could just do the opposite of? When consumers think that inflation's a problem, it's usually a good time to buy bonds. You can see that here in late 2008. Inflation expectations were high. That turned out to be a good time, and then you're seeing it now. So keep that in mind as a counter-cyclical indicator. Let's continue on with the data. The 5-year note auction went just fine. Of course, we'll get into the Fed data here in a little bit. It's important to go through this economic data and see what's going on before we get there. And let's move into today's data. Our mortgage applications up 5.7%, but check this out. Purchase applications were down. Refinance applications are up. Now, what does that tell you? First of all, it tells you that the demand we're seeing for new homes is declining. We see that in the data. But interest rates aren't at new lows. So why would people be refinancing their homes if they're not refinancing at a potentially lower rate? Because what's gone up in value? Their homes. What do they need? Dollars. So what are they doing? Extracting dollars as home equity. I bet that's what's going on, and we'll find that out, I'm sure, in the months to come that we'll see this, but it just goes to show there's a dollar shortage and that people are looking to get dollars, and homes are a great place to get them when prices are high. And you might be thinking that could be seeding a future crisis in housing. Yeah, it can, because when people get levered up and asset prices fall, well, now they can't pay on their debt because they're upside down, so they choose to default. Exactly what we saw in the great financial crisis. Let's continue on. Retail inventories, excluding autos. You keep hearing from these purchasing managers indices that there's this massive shortage in inventory, and yet Month after month, you see retail inventories, excluding autos, up 0.6%. Wholesale inventories up again, 0.8%. So it's kind of baffling that we see that, but yet the survey data tells you there's a huge shortage, but the hard data tells you a completely different picture. How about we take a look at the crude oil reports? I think we skipped over the Richmond Fed data, but we'll catch up to that real quick. Crude oil inventories down 4 million barrels, a little over 4 million barrels. Gasoline inventories down 2.2. Distilled stocks down 3.1. Overall phenomenal report, which did send crude oil higher, but crude oil is stuck. Doesn't seem to be getting out of its range. Let's take a look at the Richmond Fed data, and then we'll get in to talk about what's going on with the Fed. Now remember, this is a diffusion index, but unlike the ISM, it's important to understand that this is the percentage of firms reporting increase minus the percentage reporting decrease. So about 25% of firms said conditions were improving, the shipments were up, volume of new orders were up, backlog of orders were up. So overall these are pretty decent numbers. Capacity utilization was up, vendor lead time. So clearly, you're seeing a big lag in the system where vendors are having, you're seeing this massive lead. 63% of firms indicated increase in lead times. Business conditions, so you're seeing almost across the board about 25% of firms showing increase. Finished good inventories were down, 21% of firms. Raw material inventories down 24%, so suggesting some shortages there. How about number of employees? 36% of firms added employees. Wages, 47% up. Skills needed, this is never, they're never happy with skills in the manufacturing sector, but only 7% of firms increased their work week. So adding firms, but not adding work week. Now remember these last ones, these price trends, this is what we're looking for, inflation data. These are done on a year over year, not month over month. So prices paid up 11% from this time last year. Prices received up 7%. Clearly being squeezed at the margin, and you can see it right there. How about the services sector? Also a pretty nice picture here. Around a little over 20% of firms, you're seeing revenues up, demands up, local business conditions improving, capital expenditures are up, equipment spending is up, services expenditures up. So that's great, but only 12% of firms increased employment, but a lot of them, 36%, increased their wages. And the average work week, 18% of firms increased their prices paid up. Not a lot, 6% from this time last year. And prices received, again, you see a squeeze at the margin up about 3.4%. So they're unable to pass these higher costs on, which suggests that eventually these higher prices will be rejected. Now let's talk about the Fed meeting today, because my expectation was we wouldn't see a whole lot, and we didn't. The market was hoping for a taper talk, that, hey, we're getting close to taper, and it really wanted that. But let's look at what's going on, because I think there's several issues that we need to talk about. The first being there was no taper, and we are on track, they said. So since then, the economy has made progress toward these goals, and the committee will continue to assess progress in the coming meetings. So all that tells you is whatever the long run view the Fed has, and they will not tell us what that is, that we're making improvements. It doesn't say we're making large improvements. It doesn't say it could just be small ones. They just said we're heading down the path, and that's pretty important. So when we look at the other information here, we see there was virtually no change. We did find out that they added some overnight repurchase agreement operations, and we can see that right here, that they announced the establishment, and this was expected, 2 standing repurchase repo facilities and a domestic standing repo facility and an international one. Now, before you panic, this is a good thing, because it's a tool the Fed should have anyways, but it's an indication the Fed is concerned about a potential dollar shortage. And we've talked about how all the borrowing from the stimulus, a lot of it came from overseas. So we borrowed dollars from overseas. You see them get deposited in the financial system, and the M2 money supply goes up. It wasn't money printing. Didn't come out of thin air. We borrowed the money. So in a global system denominated in dollars, what you find out is we're always naturally short. But some of the times the shortage, when financial conditions are tight, as indicated by falling Treasury yields, gets worse. Well, where is it likely to show up? Outside the U.S., because we borrowed a lot of dollars there and we didn't send a whole lot back. So by what all the Fed is doing now, it says, look, if you have Treasury securities, you can bring them to us and we will give you dollars, and you have to pay us a small interest rate on that. It's just another tool in the Fed's toolbox. It doesn't mean there's anything wrong. Doesn't mean that anybody's jumping on this. It just means if you have dollars now, and I want you to think about, why would the Fed do this? Because how would, say, the Bank of China get dollars if it needed it right now? Well, it could take its Treasury securities and sell them. We could just do that. But now it can go to the repo window, post them as collateral, get the cash, pay an interest rate that is likely lower than its average portfolio maturity or average rate on its portfolio, and everyone's a winner. Keeps people from selling Treasury securities. It's what the Fed wants, is lower rates, not higher rates. Let's see, what else do we have in this story here? The Fed Chair Powell said that employment and inflation targets need to be achieved. Emphasis on employment targets. He was asked, can you give us some specifics? No way is he going to give any specifics. And I want to tell you there's a few reasons why. The market is asking Fed Chair Powell to taper. It's telling him, hey, you need to taper. We think you need to taper. And he doesn't want to. It's very clear he does not want to taper. So he's walking this fine line where he's trying to placate to the market, saying, well, we're making, some progress toward these goals. And when asked, what are your goals? Oh, we don't know. We're not really sure. Yeah. So what he's trying to do is walk that fine line, because I want you to think about this. If he started tapering, let's just say the Fed came out and said, hey, you know what, we're going to start tapering, and there was a taper tantrum, and then the economy rolled over, who's going to take the blame? He is. And who's out of a job early next year? He is. Because what is the first thing a politician tries to do? Get elected. What's the second thing that's most important to them? Staying elected. Now, I want you to think about this. Powell is already wealthy. He doesn't need to work. He's worth over $100 million. Which we'll presume is enough money to get him through the rest of his life. But he is the chairman of the Federal Reserve, the most powerful central bank in the world, which makes him one of the most powerful people in the world, something money can't buy. So he doesn't want to take the risk, because if he takes this risk and the economy rolls over, which he believes it's going to, I mean, we've talked about how these extended unemployment benefits are going away. And you're going to have these moratoriums on student loan payments go away. So what's going to happen? People are going to have less money, and they're going to have more bills, less discretionary spending. You don't get inflation. And then you have the eviction moratorium expiring. So people are going to have to go look for new homes or go to court. I mean, this is going to be a mess. And he knows the probabilities are high. The economy is going to roll over, and he needs to keep the foot on the monetary gas, or he could be the fall guy. President Biden could say, hey, man, you're out. I don't need you anymore. Look what you did. If he wants to keep his job, he keeps the foot on the gas, and there's no way or a very small reason that President Biden could come up with to get rid of him. And that's really important, because the markets would be spooked at this point if Powell was out. So keep that in mind. He's got every reason to keep this going. Plus, as he said in the press conference, inflation is likely transitory. We look at it over a multi-year period, not over a 12-month period or less. We think it's rolling over, and we believe. And now, how would they believe that? Well, let me show you the CPI chart. Here's year over year. This is something that Alfonso I'm going to say his last name, but I'll probably say it wrong. I got it right this morning, which is really important. Anyways, Alfonso and I, Macro Alf on Twitter, had a nice chat for Real Vision, and we talked about the year-over-year comps in the CPI, how this is transitory. And I want you to see here, right now, we're coming up on the July data next month, and look what happens to the year-over-year comps in the CPI. They continue to rise, meaning in order to keep this trajectory, prices are going to have to go up substantially, and the probabilities of that are pretty low when you look at the fact that durable goods new orders are rolling over, and as we've seen in prior recessions, people cannot afford them. And so with that, we'll wrap up today's show. Again, as always, appreciate all of you being fans, appreciate you watching, appreciate you supporting the show, and with that, we will be back on Friday for the macro show. And of course, we're here with the Castle Walls. You saw today, the bond market's defended. We'll talk about that soon. Again, thanks for watching. Take care. Bye now. The content of this video is provided as educational information only, is not intended to provide investment or other advice. Shows not to be construed as a recognition or solicitation by selling securities, financial instrument, or to participate in any particular trading strategies. Video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video now do not reflect the Atlas Financial Advice Inc. or Steven Van Metre Financial.